In the late 1920s, the world economy was like a delicate balanced house of cards. The key card that held up the rest was American economic prosperity. If the United States economy weakened, the whole world's economic system might collapse. However, in 1929, it did. A flawed U.S. economy. Despite prosperity of the United States in the 1920s, three weaknesses in the U.S. economy caused serious problems. These were uneven distribution of wealth, overproduction by business and agriculture, and lessening demand for consumer goods. By 1929, American factories were turning out nearly half of the world's industrial goods. The rising productivity led to enormous profits. However, this new wealth was not evenly distributed. The richest 5% of the population received 33% of all personal incomes in 1929, yet 60% of all American families earned less than their goods. Store owners eventually cut back their orders from the factories. Factories in turn reduced production and laid off workers. A demonic spin began. As more workers lost their jobs, families bought even fewer goods in turn. Factories made further cuts in production and laid off more workers. During the 1920s, overproduction affected Americans' farmers as well. Scientific farming methods and new farm machinery had dramatically increased crops yields. American farmers were producing more food. Meanwhile, they faced new competition from farmers in Australia, Latin America, and Europe. As a result, a worldwide surplus of agricultural products drove prices and profits down. Unable to sell their crops at a profit, many farmers could not pay off the bank loans that kept them in business. Their unpaid debts weakened banks and forced some to close. The danger signs of overproduction by factories and farms should have warned people against gambling on the stock market. Yet no one heeded the warning. The stock market crashes. In 1929, Wall Street in New York City was the financial capital of the world. Banks and investment companies lined its sidewalk. At Wall Street's New York Stock Exchange, optimism about the booming U.S. economy showed in soaring prices for stocks. To get in on the boom, many middle-income people began buying stocks on margin. This meant that they paid a small percentage of a stock's price as a down payment and borrowed the rest from a stockbroker. The system worked well as long as stock prices were rising. However, if they fell, investors had no money to pay off the loan. In September 1929, some investors began to feel that stock prices were unnaturally high. They started selling their stocks, believing the rates would soon go down. By Thursday, October 24th, the gradual lowering of stock prices had become an all-out slide downward. A panic resulted. Everyone wanted to sell stocks, and no one wanted to buy. Prices sank quickly. The wild shouting of 1,000 brokers and their assistants at the stock exchange became what one observer called a weird roar. Prices plunged to a new low on Tuesday, October 29th. A record 16 million stocks were sold. Then the market collapsed. In the stock market crash, billions of dollars in paper wealth simply vanished. People could not pay the money they owed on margin purchases. Stocks they had bought at high prices were now worthless. Within months of the crash, unemployment rates began to rise as industrial production, prices, and wages declined. A long business slump or depression followed. The Great Depression, as it came to be called, touched every corner of the American economy. By 1932, factory production had been cut in half. Thousands of businesses failed and banks closed. Around 9 million people lost the money in their savings accounts when banks had no money to pay them. Many farmers lost their lands when they could not make mortgage payments. By 1933, 1/4 of all American workers had no jobs. A global depression. The collapse of the American economy sent shock waves around the world. Worried American bankers demanded repayment of their overseas loans, and American investors withdrew their money from Europe. The American market for European goods dropped sharply as the U.S. Congress placed high tariffs on imported goods so that American dollars would stay in the United States and support American workers. The government was trying to force Americans to buy American goods. This policy backfired. Conditions worsened for the United States. Many countries who depended on exporting goods to the United States also suffered. Moreover, when the United States raised tariffs, it set off a chain reaction. Other nations imposed their own higher tariffs. World trade dropped by 65%. This contributed further to the economic downturn. Unemployment rate soared. Because of war debts and dependence on American loans and investments, Germany and Austria were particularly hard hit in 1931. Austria's largest bank failed. This started a financial panic in Central European countries and sent their economics plunging. In Asia, the Japanese economy also slumped. Japanese farmers suffered greatly during the Depression. In the rice-growing areas of the Northeast, crop failures in 1931 led to famine. Starving families ate tree bark and the roots of wild plants. City workers suffered, too, as the value of exports fell by half between 1929 and 1931. As many as 3 million workers lost their jobs, forcing many to go back to their rural villages. The economic crisis fell heavily in Latin America as well. Many of its nations were tied to the global economy by trade in such cash crops or raw materials as sugar beef, copper, and tin. During the 1920s, world prices and market demand for these products were already dropping as European and U.S. demand for Latin American products dried up. In the 1930s, prices for these goods collapsed. At the same time, the cost of imported goods rose, pushed up by high tariffs. Latin American nations that had borrowed heavily from other nations could not repay their debts. The worldwide crisis spread rapidly, so the world was in deep crises, not knowing whom to turn to for survival. On our next video, we shall talk about how the world recovered from the Great Depression.